Ladies and gentlemen of the crypto space, we're live on a Monday, November 27th at 11:30 a.m. Cycles past the past, and you really need to go back further than just 20. The turn of the tide, the turn of the cycle at the Q4 2017, Q1 2018. You have to go back to earlier cycles, and you really need to understand, obviously, 2008, the global financial crisis, to understand the structure of this system. But to be concise, we can talk about our most previous cycle. 2017 was a hot year. Markets ran up, volatility in the system was relatively low, and allowed the crypto space to expand significantly. And we peaked out literally in Q4 2017, and then bam, October, November 2017, tide turns, particularly with regard to volatility, and then in January of 2018, market rolled over and rolled over and kept rolling over. And then we had some relief in February of 2019. Let's take a look at the chart and give you some visual perspective on the matter. Take a look at this. So this, first off, we'll end on the note I was just thinking. What does this whole cycle mean compared to where we are now? And that's the story. That's the most important part of the story. But let's take a peek at something that's interesting. All the way in Q4 2017, market top. About January 2018, everything rolled over, so it was in between. Let's take a look at the move indicator. Ooh, if I can click it. So here's your January 18, December 17. Let's zoom out, get some perspective. So for the entire year of 2017, collateral volatility in the system was falling. And then in January of 18, you had a big rip to the upside. So notice how there's plenty of big rips in here. You had rip in October, and you had big volatility, obviously leading into March of 2020, and then blow off in April of 23. But this kind of volatility was a shock, particularly because for one entire year, the bond market, treasuries in particular, were relatively calm. And we see that even a small move in this indicator could have dramatic effects. So what's happening is a couple of interesting things we could get into. The volatility in the system is getting more extreme, and this is an absolutely monumental move. And the only thing comparable to this move, September of 2020 until March of 23, is literally GFC 2008. Just remarkable the last couple of years what happened with collateral. Volatility, extraordinary, but it's a different type of volatility. Dumping volatility. Anyway, so off the bottom in January of 18, this little bit of collateral volatility was enough to roll over crypto markets. And it was a very different crypto market as it is today. This chart tells a very different story with regard to Bitcoin pricing. This was a different world between 2018 and bottom in Q2 2020. Completely different world. It was literally just Bitcoin and Ethereum, and everything else completely was annihilated. Nothing remained. There was no market. Stablecoins weren't what they are today. Stablecoins were weird. Back in 17, when you heard of like USDC and USDT, you're like, what the hell is this shit? What the hell do you want a dollar? You want a token that's a dollar? It was really weird because in those days we were literally we were master noding and compiling, daemons to run nodes and mine like solo mine. It's like literally a different world. There was nothing. It was the stupid ICOs, and that was just a capital raise that went nowhere. And it was just speculative frenzy, which we have today with what folks call the meme tokens, which is basically the ICO. Memes now are what ICOs were back in 17. It was just nothing. It was vapor. So when the capital got sold in 18 and then finally bottomed. Then we had our rally and even dumped into March of 20. There was no market. The capital was dumping into centralized exchanges, and what are you going to do? What are you going to buy? No, there was no DeFi. There was no stablecoins. Were still weird. All the way into March of 20, stablecoins were freaking weird. You got to understand how different 18 and 19 and even like the Q1 of 2020, what the hell were stablecoins? We didn't have a sense of what stablecoins were until you started to see the concept of LPs and the pairing of assets, you know, the two-sided LP, the traditional LP of Uniswap. We had a coin and it was paired with a stable coin, and that creates a price because of the balance of the LP. That's when people started to see what stable coins were. Stable coins were so weird in 2017. They didn't mean anything significant. You can imagine, Circle having that kind of foresight. I mean, I don't think anyone could have seen this coming. What the AMMs have done. So this market is entirely different. We actually talk about it in terms of a market. There was no market in 18 and 19. It was all centralized exchanges. This market now has the concept of a stablecoin that has significance. It means something. The concept of liquidity, and now we talk more, TradFi financial terminology to describe the nature and structure of this current crypto market, what it has emerged into, or evolved into, rather. And the difference is night and day. We still have the cyclicality we must observe with regard to the collateral market, but the collateral market has expanded significantly, and so has the liabilities market. Total dollars in circulation. The structure of the system is very different as compared to 18 and 19. 2020, M0 has come down a little bit, but M2 expanded significantly, and if everything is on track, which it likely is, 2024 is going to be a significant expansion further of collateral in the system. And overall, all that translates into is significantly more liquidity in the system, which will make 2024, depending on where you want to, where the collateral starts really printing liabilities, Q3, Q4, Q of 24, and Q1, Q2 of 2025, the liquidity situation for the global financial system will be so incredibly different as compared to 18 and 19. And 18 and 19 were nothing compared to, obviously, the earlier time periods, a whole nother level. Move indicator will show us the way. This is such a remarkable run up from September of 2020 until March of 23. And what's fascinating is collateral volatility. You literally had a rally. You had a rally in risk. You had a correlation between bond market volatility and the global risk activity in crypto markets, which is strange, and that's not something we historically saw. We have had an inversion of the correlation. I expect a normalization to a degree. It wouldn't make much sense for that relationship to persist for a further extended period of time. And we've seen a correlation as this pattern topped. We saw a bottoming in 2023, Q4 2022, and that's all here. Move would be a leading indicator of systemic liquidity, and clearly there's a blow off in April, but it's generally a topping pattern here. And my expectation is pretty much well defined. It's not really a rolling top, but this is clearly a long time frame topping pattern. And the general relationship is, as volatility comes down, with collateral pricing, and this is the Treasury market's volatility, that has a capacity to increase systemic liquidity. But that is also in itself a leading indicator from like a 3, 4, 5, a longer time frame perspective of the potential for increased instability. Because then what happens when this bottoms and then everyone is risk off? So it is very important to understand how risk on leads to risk off, and this cyclicality, that cyclicality is going nowhere. Base case is we see maybe some support. We see a nice run down to the 85 region, and that'll be a big rip to the upside across the risk asset landscape. It'd be fascinating to see it really fall down. I don't know what kind of conditions would really cause it to fall down, but 2024, you flood the system with treasuries. Systemic intervention is literally going on right now in China. They're on the cusp of a deflationary contraction that's pretty epic. They're having their own financial crisis right about now over there in commercial real estate. We'll see what happens around the world. I guess the only way for the volatility to be suppressed to such a degree to get us back to 2020 lows is some sort of artificial intervention. But is that something that would be unexpected? Isn't that standard operating procedure at this point? So there's plenty of reasons for this to get cut short at 100 SMA, at 200 SMA in the monthly. And there's also reasons for it to go even further. The significance of this chart, along with inspecting maybe bonds granularly, but certainly a general FX perspective offered by the DXY, is top. We'll have a much better indicator of top as this chart returns to the normal inverse correlation rather than correlation with risk-taking activities. When this bottoms and we see a vol spike, that means someone's probably going to blow up. That's why it's a leading indicator. Vol spike implies bond market is convulsing, prices are doing something unexpected, and that has a tendency to blow up balance sheets. Get a big enough vol spike and everything blows up, and that was March of 20. And notice how it was February, it wasn't even February, it was January of 20, you started to have the vol spike. And the stock market did what it did in March. So this was a pretty good leading indicator of top in equities and in the crypto market as well. So take a look. This is the monthly chart. January of 2020 was top. That's what this says. Let's look at crypto. In January, yeah, nice spike up. So the top. So it tells you when you have a vol spike in collateral, you're going to have some sort of knock-on effects that increase systemic instability, top, and everything rolls over. And that was just a massive vol spike as well. January of 20, from a currency perspective, right about here, bottom. So the dollar rallies, and it was a big spike heading into March of 2020, along with collateral volatility, because the collateral becomes unpredictable and things blow up and everyone has fear, so the dollar gets bought in response to that fear. So we have great indicators that will give us a better capacity to navigate this current cycle as compared to 18 and 19, because now we see this great connection between crypto markets, or what the crypto markets have become as compared to what it was in 17, parts of 16 and 17. It was literally just speculative fever, which we see in these markets, but it's not the same fever. It's the same, but it's different. Look at all the sticky liquidity in these markets. I guess that's the only way to really get granular about it, is you could describe the differences and obviously note the similarities. And the similarities are going to have you speculative insanity, but the amount of sticky liquidity now is incomparable. to whatever market conditions we had a couple years back. There was no market conditions a couple years back. You couldn't even talk about these markets in those terms a couple of years back. I hope that makes sense. It is different in that regard. It is not different with regard to the speculative insanity, the irrational exuberance, the degeneracy. That is lo mismo. It is the same exact thing. But in 18 and 19, there was nothing we could define as a business. There was nothing we could define with as having cash flow and a return of capital to investors. There was nothing. There was clearly no real world assets and sovereign debt pushing financial yields through the system, which drives activity, and how we've discussed incentive systems over the last couple of years. There was none of this. Incentives and yield and derivatives and leverage. Risk appetite is always inversely proportional to volatility. Clearly if you're leveraging Ethereum and the volatility is relatively low, it's hovering at 2,000. Let's say it hovers at 2,000 for the next 3 months, and you borrow against it. It means you're increasing the liquidity in the system. And then Ethereum drops to 1,900, ramps to 2,100. You're like, what the hell? All right, so you take some leverage off. You are destroying some liquidity in the system because of the volatility, which creates uncertainty. And you don't want to have excess risk exposure with regard to the amount of leverage you've taken. And that's exactly what occurs at a larger scale with regard to treasuries being used as collateral. That was an example using Ethereum that was an example of using Ethereum as collateral. And that's the exact same thing. So this is great examples in crypto markets of how the global financial system works in many regards. Clearly the derivatives are much more sophisticated in traditional financials, and the tendency for crypto protocols is to present derivative products in a more palatable and retail consumer friendly package, which is a very interesting thing. It's a big thing. It's a democratization of financials, but it's also, unfortunately, the easing of access to potentially degrees of risk that are unreasonable. So you still must be especially cautious, and you must digest these systems and understand their historic analogy, their TradFi analogy of what they are in meat space finance, so you can engage with them as a rational financial manager in the crypto markets. Because you have decades of history with these types of products. So why not learn and inspect this data that we have to understand what drives their behavior? Same exact thing. You get Ethereum volatility. Bitcoin's used to a lesser extent as a collateral in crypto markets. But it's going to be interesting when Ethereum appreciates significantly how many liabilities, what kind of endogenous dollar creation occurs in these crypto markets. And that's what we need probably actually is an Ethereum vol indicator, which is what we have in equities markets with the VIX and what we have in the treasury market with MOVE. An Ethereum vol indicator would be interesting. Clearly, there's no data, meaning what do you have, 3 years worth of data to indicate what on how the price of Ethereum correlates to liability printing. You need years of data to see these kinds of trends to establish correlation or inverse correlation. Well, that's what we have here. I mean, it's not a huge amount of data, but it goes back post.com bubble, and it gives us a great deal of perspective on the evolution of traditional markets and how the great financial crisis mutated the financial system in so many remarkable ways. Tapsy's in the house. Idan, the absolute king. Thank you. Well, not me. Maybe Ethereum or Bitcoin. I don't know. Crypto Jake. Good morning. The cap, everyone. Loki, good morning. Asarco, made it live. Sergio, present. ETH Merger, good morning. DeFi Futurist. Hi, Cap. Hi, guys. Good morning, everyone. Good afternoon, or wherever you are around the world. So, broadly across the space, things appear to be a bit depreciative. So, what does that mean? Let's zoom out. Let's take a look at the dollar. Let's give a better perspective. So, the dollar is working off a very large wick to the downside a quarter ago. And there's 1 month left in the quarter, so we still have plenty of time. You'd want to see it close below the open of the last wick, which is about 102.991, give or take. The reason 102.991 is interesting is because that was basically the blow-off top in Q1 of 2020, and it was basically a big top in 17 as well. So if we hold resistance at the 102.991 level, that invalidates this entire move above 102.991 since April of 22, which would be quite indicative of a continuation to the downside, a rejection of that move to the upside all the way above 114. Some meaningful support that's potentially in place, a 10 SMA in the 3-month. So there's still a great deal of uncertainty in the market. We'll take a look at, obviously, the Ethereum and Bitcoin charts, but the direction is trying to be solidified right now. What you want to see is a rejection, zooming in a little bit more granularly, is a rejection of the move above the monthly time-weighted average price. It's a relatively small potential directionality reversal. This is a nice wick to the downside, a nice hammer, indicating it's a candle that's very, very nice, very good at indicating directionality reversal. And then you wait for the follow-up candle for confirmation, and this is a perfect 2-candle pair indicating directionality reversal. And we didn't see effective resistance at the monthly time-weighted average price. It blew up past it, and it looks like it rolled over. You need a close below the time-weighted average price on the monthly, and that is comforting. So what you want is points of confluence. You want comfort on the monthly. You want comfort on the 3-month. And if you have comfort on the monthly, you don't really have to look at the weekly. The weekly will drive you nuts. 3 days left for comfort on the monthly. You're not going to have comfort on the 3-month for quite some time. There's an entire month left in this candle. Got to get below the blow-off top in January of Q1 2020. Got to get below the 102.991. That'll be comforting, but then you have the damn 10 SMA right there. So this is why it looks like Q1, Q2 2024 will present the most interesting potentially favorable conditions. A breach below the 10 SMA in the 3-month from a dollar perspective, and there's good chance everything pushes further lower to the time-weighted average price in the 3-month, and that will be quite interesting because that's below 100, and that's a psychological threshold. This whole chart collectively tells us we're in a state of flux. You know, we opened this stream because we wanted to talk about the wonderful activity we had in 2017 and then the bearish conditions we had in 18 and 19, and that is literally an expression on this chart in a simple line. I've showed this to you guys before. This is your entire 16-17 bull market right there. So that's why we inspect the dollar. But there's more than just the dollar, because the dollar is a bit of a knock-on effect with collateral volatility. And that's greatly influenced nowadays because of Japan and their fiscal problems, which is putting a lot of stress on the system. But it looks like so. This is cyclical stability. You know, as collateral vol comes down, Japan may have a little bit more time, and the dollar may get sold, the yen may get bought, and that's where the entire financial system starts to restructure because historically, every time the yen rallies, everything is falling apart. So as this falls down, everything should start to fall apart in equities land. I think I think a lot of folks have a good. Uh, there's a whole conversation to be had about equities unto themselves. My general take is independent of earnings and whatever that happens into the end of the year, Q1 2024. I think the whole equity space is prime for a recomposition of what it means to be a good investment. And there's just been horrible malinvestment for way too long. The potential is there for a great reallocation of capital to many of these digital enterprises that have much better properties as compared to large swaths of the meat space equities markets. And that's pretty much a base case for myself at this point, because inspecting these companies, they just look so much better. And these are companies. And these companies did not exist in 2017, not even in ICO form. There was not even the overtone of the types of companies we have today as compared to the shit that was being peddled and bought in 2017. Nothing even comparable. I mean, the entire list of stuff that I look at from a trading view perspective didn't exist. Solana didn't exist. Cosmos didn't exist. Polkadot didn't exist. Or sure as hell didn't exist. Stargate Curve, Convex, none of this stuff existed in 2017. It wasn't even a sparkle in their eye. ICOs. You can't even talk about the narratives of what these ICOs were purporting without laughing. In hindsight, it was just a pure capital raise. Vaporware in all regards. 29 people in the stream. Oh, these markets must be doing something good nowadays. They do look good. Japan needs to hold that damn 200 SMA on the 3-month as resistance. That's pretty scary. So there's plenty of things that could cause systemic instability. And what does systemic instability look like? I mean, look at Q1 of 2020 on the Bitcoin chart. I mean, all of this is still very much in the cards. Plenty of things could blow up at any given time. I mean, that was literally a 40% correction in the Bitcoin price in a 3-month time frame. A 39% correction from here puts us at $22,584 per Bitcoin. So the price action move in March of 2020 is equivalent to a crash of Bitcoin from current 37,000 to 22,500. So that's what effects systemic volatility can have. So that's why I look at these macroeconomic indicators to assess the potential for continuation to the upside from where we are, or a directionality reversal induced by systemic volatility. Now, interestingly enough, in 2019, we probably could have seen a bit of continuation or a horizontal chop. And that's kind of what we're seeing right now is 2019. So this market to me feels a lot like 2019. Clearly different in all the regards we've discussed, but similar in that a bottom has formed. We have plenty of higher highs quarter over quarter. but we're heading into the type of conversation of, does that systemic instability reemerge to interrupt this recent price appreciation and cause a reversion to the mean? Now, they really stood up that BTFP real quick. So in 2019, September of 2019, the U.S. banking system failed and they stood up the standing repo market. Since then, however many temporary, four-letter facilities of the Fed have since been shut down, the standing repo facility and the standing reverse repo facility remain. And they created a new facility, the BTFP, in March of 2023. And all of these things are designed to reduce systemic volatility, to interrupt and short-circuit the capital destruction process, the bank run process, or whatever is going to still play out with commercial real estate, whether that gets absorbed, or written off in some way, sold pennies on the dollar, and which is capital destruction. Someone's balance sheet is going to hurt because of that. But do those things cause the kind of systemic instability and volatility we saw in March of 2020? Probably not to the same degree. Quite a different time. Government-induced voluntary shutdown of the economy. I mean, something of that scale could be commercial real estate imploding and taking out 30% of the U.S. banking sector. Okay, so why is that impossible? It's not impossible. It's quite possible. So mean regressions are to be expected. So the path is uncertain. The path will always be uncertain. But I think the destination is clear as day, because no matter what kind of systemic instability we have, you'd literally not be able to run the government if there's enough destruction, because tax receipts wouldn't be there, and then you have your death spiral with fiscal, and then literally just doing fiscal will inflate the currency supply of the planet, and there goes crypto anyway. All roads lead to this asset class appreciating better than any asset class for innumerable reasons that we continue to discuss. The destination is clear. If you zoom in a bit, let's zoom in on the 3-month time frame chart. So I don't think a 39%, that's crazy, because that was a voluntary shutdown. And it wasn't even that, because I showed you guys bond market volatility starting in January of 2020. Look at that. So the bond market volatility really exploded in January of 2020 from a bottom of 49 to 72. 49 to 72, and we discussed in January of 18, this is what time frame correlates to the top of the market. It's Q4 of 2017. In January of 2018, everything started to roll over, so you see a big spike in bond market volatility. But it was a much bigger spike in January of 2020. Look at that. That is a very large spike, leading to the blow off top in March. But as a forward-looking indicator, these are very clear tops, but forward-looking. So you could have a month, 2 months for the effects of this volatility to have a depreciative, a topping effect in crypto markets, which makes this entire region here between March of 2022 to today so fascinating, because there's such a massive structure. Look at this congestion of bond market volatility at this elevated range for such a long period of time. It's historically extraordinary, with the only comparison being the GFC years. And you have this wild aberration, such a massive blow off top. That's such an extraordinary amount of volatility in such a short period of time. And that makes this candle all that more wild, or just reasonably said to be unexpected. Plenty of reasons for a mean regression, but I don't think the mean regression would be 39%. So from a 3-month time-weighted average price perspective, let's put that back, you're looking at potential mean regressions, standard rules, things return to the mean. About half that, 15%, 31. If we have systemic volatility, something blows up in commercial real estate. I mean, something is outside the realm of the BTFP and a large enough bank gets impaired. Whether that creates, the cascade effect of a run on banks is another story. But there's no reason Bitcoin can't retrace 16% to 31,000. That would be a mean regression. And this is some standard shit right there. Dan's in the house, a pleasure. Ethereum looks much more favorable, in my opinion. Has much more potential for upside. I love looking at a very zoomed out chart from a 3-month perspective. 25,000% was the first run on Ethereum. That was your 2017 top, Q4. That was a hell of a run. Ethereum ripped between March of 2020 lows to the top, about 5,200%. What's a decent expectation for Ethereum? It depends on liquidity conditions, but I think there's a good setup in 2024, barring some sort of volatility event, for a 10 to 20x. 10x puts us 20 plus thousand. 20x. Why? Because it would be strange for Bitcoin to run a 20x. My expectation is probably a 10x in Bitcoin, and that's kind of consensus. About $250,000 plus, 300,000 sounds a bit crazy. So what conditions would allow that to occur? You need to see the volatility come down. If you see the move indicator really roll over, you need to get back to below the 3-month time-weighted average price, below 100. And coincidentally, you need to see the DXY dip below 100 as well. And we've talked about the reasons why the dollar coming down and the move indicator coming down would create this kind of price action in these very liquidity sensitive assets. Dollar rolling over increases the purchasing power of foreign fiat currencies, more relative liquidity. And then the collateral volatility rolling over is like Ethereum trending sideways for 3 months. What the hell are you going to do with your Ethereum? Oh, let me borrow some dollars and explore some sort of risk-taking activity. And that's the same thing occurs with global treasuries in plenty of countries, not just U.S. treasuries, but predominantly U.S. treasuries. And there goes the flood of liquidity through the system because there is trillions of dollars of these treasuries globally. And 2024 has all of the setup necessary for significant appreciation of liquidity-sensitive assets. So we keep our eyes out for the volatility, which temporarily interrupts that process. But that process is critical because it's all cyclical. The liquidity in the system is contracted, therefore it must expand. And what they want to do is control the expansion to the upside, because when it rolls over and it starts contracting again, they need to add liquidity to the system. It's the same reason they jacked rates as fast as they did. They jacked rates as fast as they did because when they need to cut, they have room to cut down to 2.5%. And then they'll have to raise rates to 7.5%. And then they'll have to cut the 5%. And you get your higher lows and higher highs on rates heading into 2030. And it all makes sense. They try and counterbalance everything. Are they good at it? I would say they're actually pretty good at it. Most folks think the Fed is making mistakes, and in regards they are, but they have kept the system from blowing up, and that is something that is notable. The system persists because if it wasn't for their interventions, none of us have experienced a full business cycle. I remember 2008. It was pretty miserable. I didn't know the financial markets back in 2008, but I was fresh out of college and there was no work. There was nothing. It's the closest I could possibly get to the sentiment of, dare I say, what they had back in the Great Depression. It was miserable. So the question becomes, can the system tolerate that? And so many would argue the system cannot tolerate that. So many would argue that federal tax receipts cannot tolerate that. Therefore, they must intervene. And then everyone says there'll come a point where even their interventions don't work. And then everyone in the crypto markets say that's when fiat fails and the Bitcoin standard emerges, and then only people with Bitcoin have money and everyone else is poor and starving and killing each other for food. But if you have Bitcoin, you're okay. That is clearly not going to fix that condition at all. So let's take a look at a couple of other macro indicators. Gas found support on the 10 SMA, 50 SMA on the 3-month. We want to see gas roll over. It needs to find a little bit more pressure to the downside. That would produce more favorable conditions in our markets. Oil found support as well. Time weighted average price on the 3-month. A nice move down, but that'd be crazy. He starts to see oil push through these support levels down to the 50s, and you're going to see some interesting price action in dollar markets. The DXY rolls over, DXY rolls over, MOVE rolls over, and 2024 will be a wild year where Bitcoin and Ethereum outperform to a greater extent, which is where you get that 350,000 on Bitcoin and where you get that 40, 50,000 on Ethereum, and that's the froth conditions. And then that's guaranteed to roll over, which is why we talk about portfolio composition. And I have to manage those assets from an FX perspective. But we're in a much better position to see when things are extremely frothy, when things are going to roll over, and we'll have a leading indicator, which basically means, Bitcoin's at 200,000 and MOVE spikes. You get literally a 30-point spike on MOVE. All right, maybe you hold on to Bitcoin for another 2 weeks, a month, but the odds are that thing's, if it's overextended, it just had a 20% rally in the last month, it's gonna produce a hell of a shooting star with a MOVE spike like that. Or you start to see a higher low on like a DXY on a daily and then a weekly. And then if you see confluence saying the dollar is bottoming, MOVE is bottoming, it's not just a crazy candle on MOVE. You start to see bottoming patterns on both those tickers. You're probably getting into a top situation. So what? You miss a month or 2 months of Bitcoin appreciation. Yeah, Bitcoin goes from where it is and it goes 10x from where it is, and you're going to miss an extra 1x or 2x. No, that's when you rotate your damn FX assets, and you know what's going to happen because we've seen it. We've seen it time and time again. We're going to have some great indicators heading into our FX management requirements, speculatively 2025-ish. Going to be very interesting. Asun's in the house. Much a pleasure. If you guys have anything on your minds, otherwise we really covered some interesting stuff today. It's a good part of the 2010s that give us a sense of how different we are in this market as compared to cycles past. But you can't really compare to cycles past. This crypto market cycles past. But these crypto markets in cycles past have led us to understanding these macroeconomic forces that will give us a much better capacity to manage things literally going forward. And that changes everything. And what's very notable is I expect these crypto markets going forward to respect these macroeconomic forces much more than they did in 16 and 17. And not even the earlier cycles. The earlier cycles were just degeneracy. And so clearly 16 and 17 were just pure degeneracy, but we now have a different market structure that has more of a capacity to respond respectfully to these macroeconomic forces, these liquidity, the flows in and out of the system. If you see a 10x increase of liquidity on Ethereum, what's going to happen to the assets on Ethereum? They're going to inflate like crazy, because what is that liquidity going to do? You think it's just going to sit there, sit parked? Oh yes, my savings account. No, it's going to be speculating and owning assets. And what assets? Cash flow. Or degeneracy, where it's appreciating at 10% every 10 minutes. And then it's going to liquidate back to the savings. But the capital is going to be sticky this time. Much more sticky, I think, than we just experienced in 2022. I think that's a great foreshadow of what's to come, of the capital expansion, not just the endogenous, but the exogenous flows into the space, because this is now a space. This wasn't a space in 18 and 19. It wasn't a destination for capital. It wasn't a market. And it certainly wasn't definable, as I define it, an emerging market. A reason for capital to flow here. Now exists, whereas it didn't exist. It is different in all regards, this time in that regard. A lot of regards. Let's wrap it up. Oh, Dan, can you please talk about timing with buying assets after initial spike up in price? Yeah. So, this time, compared to, let's say, 2020, yeah, everything in 2020, you were heading into it thinking in terms of like ICOs. It's the only comparison you had. So it's all speculative, but now the capital will allocate to assets that have an actual narrative. What kind of narrative? A business narrative, a cash flow narrative, a productivity, something that is actually useful as a financial service, trading, transaction fees. So we have much more information to go on of where the destinations of capital will be, which is extraordinary compared to 2020. And it really, consolidates these markets, because you look at CoinGecko and you see like 11,000 coins, and just all of them are useless. And you're talking about what, 30, 40, 50 assets, if you stretch it, that have any type of systemic significance. But you still get diverted from the mean. So I see why many assets have run up significantly, but it's imperative to always remember that the same rules apply. Things will get overextended. If a person owns something and it just ripped 10x and they turned $1 million into $10 million in Q4 2023, they're going to take their profits. Or maybe they wait for January, because then they don't have to account for capital gains until 2025. So this rally that we're currently seeing, and there's a lot of support. This is not indicative of reversal in any regards yet. Could easily run into January, and then you get your tax selling, because there's a tremendous amount of profits that have been made thus far in Q4 2023, and folks can to kick that can down the road until Q1, Q2 2025, merely by waiting until January of 2024. So the mean is a magnet. Things will always revert to the mean. Now, it might not be the case with the macro assets because they're not significantly diverted from the mean, and technically even Ethereum hasn't even broken out yet. Note on the 3-month, it's still below the 10 SMA, and that's quite interesting. And what are you going to have, a mean reversion to the time weighted average price in the 3-month down to 1900? Oh, is that a mean reversion? I think that's just like an intraday correction at this point. So, it's very interesting. Cow. That's a hell of a protocol. I mean, that is literally the only thing I use nowadays. I played around for 5 minutes on Arbiter. I'm like, oh my God, get me back to mainnet. I don't want to use anything but CowSwap. I mean, what am I using on the other networks? I'm not going to use a DEX. Nobody trades on a DEX. No one trades on Uniswap. No one trades on, no one, I mean, unless you have to. There's rare instances, but no one trades on Curve. No one trades on what Camelot or whatever you have on Arbitrum. You go to Paraswap, you go to some sort of aggregator of aggregators. So on mainnet, what's better than CowSwap? I mean, it's literally a signature. It's got to be one of the best designed trading experiences in that regard. Since what Rook, but that kind of never caught any traction. But that was similar in that regard. You submit an order and market makers figure that shit out for you and settle the trade. So there's nothing really comparable to CowSwap. So CowSwap is significantly stand out. Now, obviously, speculative cash flow, there is no cash flow. So people front run the shit out of that. Dare we look at technicals with mill and liquidity? I mean, come on. It reverts to the mean at some point, and if it doesn't, this is what I said the other day. Something, if it ran, it's okay. You let it go. Like if you own it down here, that's cool. It can fall 50% and it doesn't matter. So obviously that's big props for folks on Discord that took a piece of cow or FXN, and that's cool. And maybe if you're depending on your risk profile, you get a 50% mean reversion down to what is this? SMMA. I don't even know what the hell this is on Gecko Terminal. It's not like a time weighted average price, which I prefer much more. Maybe I try and pull it up on Deck Screener. And maybe what's that? That's the buy the dip. This isn't the dip. So you got to follow rules, in my opinion. And that's what I would always encourage. Don't chase. Either get a damn discount or you don't. So you see support on some sort of meaningful moving average after a significant correction. And if you appreciate the narrative that a protocol, an enterprise expresses to that degree, that's the opportunity to take a piece. This ain't no dip. And a similar situation for, I was looking at Grail. So speculative. It's just not entrenched the way I want something to be. I just want to have much more confidence in an acquisition. I mean, the only reason Prisma encouraged some allocation, one because of an airdrop, and that was free and it was tax friendly. And two, it was completely integrated in the convex and part of the entire Curve Federation. So it's very interesting. And you're telling me with FRX ETH being a major collateral, they're not going to deploy capital. So we're already seeing that. So there was confluence. Some nice vote rental revenue is potential in the future. So look at this. The point of this is a foreshadow. So early in the life of this business, we're already seeing capital like this being deployed. That's cool. So this is speculative. in my speculative category, but there's some good confluence suggesting the direction it will trend. Clearly, there's plenty of risk, token unlocks and vested interest. I mean, Justin Sun is a primary borrower, primary provider of collateral. So there's plenty of risk. So, but compared to what? The unknowns of what happens with an AMM on a side chain, I still have plenty of opinion of side chains and where they head. I have more of an opinion of Solana compared to Arbitrum and Optimism, where they fit into the system structurally. Maybe even more of an opinion of Cosmos hubs. You know, the networks, all of them, not just one in particular, of where that fits into this overall system that's emergent globally, as compared to even Optimism and Arbitrum. I mean, literally, you do the same thing on Optimism and Arbitrum as you do on Mainnet. The big difference is fees. But these systems, I don't want to digress too much into where I see those networks fit in. It's just, is it retail? Is it retail trading? That's not globally significant. Retail isn't using collateral to print currency in any globally significant way. And would those globally significant actors be operating on Arbitrum and Mainnet, or Arbitrum and Optimism versus Mainnet? They'll be operating on Mainnet. So that's as condensed as I can make that argument. So the point being, I look for these pieces of confluence to allocate, and I look for the discount. FXN. Man, that thing moves. So FXN has some serious narrative to it. LSD, and there was an FUSD or whatever they're doing. They're doing the same thing, similar things as what Frax is doing, separating the yield component, and that's some very nice scarcity, a lack of excess emissions, so there's very scarce asset, and coupled with the fact that there's a lot of yield, and that's going to drive a lot of appreciation. So let's take a look at where we are technically. Very similar to cow. Big run up. Been following this SMMA much more, so that's interesting. So where does it go from here? It's already run a 10x. Well, maybe not. It's about, let's say, 14. 10x would be 150. So to get a 10x, it has to go to $1,500. Sure, 1,500 is in the cards, but is this the kind of exposure you want for a 10x when literally the odds of Bitcoin running a 10x are clear? We've discussed that. And what's the potential volatility? The volatility of Bitcoin is likely to be less than an asset that has a smaller market cap. Frankly, this is a micro cap. So these are all factors to consider. If this 1,500, all right, fine. You know, that's probably getting interesting. It's a $5.4 million asset, market cap asset, 50 mil. All right, even if it goes to a half a bill, all of a sudden it becomes a serious asset, and that's what it takes to become a serious asset. That's 100x. All right. So you're not going to necessarily get a discount because it's run up significantly. And you're going to have profit takers because if it goes another 100x from here, these boys are going to be sitting on an absolute fuck ton of profits. So these types of assets warrant proper position sizing. And that's all that matters. You carve out, this is the type of asset that's suitable for 1% because 1% goes 100x on the money. That changes the composition of your entire portfolio. So just food for thought. All of these things are factors, points of consideration. And now we're heading into the conversation of capital management, portfolio management, and portfolio structuring. So we started with a lot of macro. We started with comparisons to different time frames in crypto history. Talked about some great macroeconomic indicators that give us a sense of where we are. Now we're talking about portfolio composition. This is a very thorough stream. Hope that helps, Dan. Do you have any thoughts on FXN creating the new stablecoin? Yeah, all of this sounds interesting. And there's real cash flow because it's based on Ethereum. And there's real cash flow in Ethereum because Ethereum will have a reduced volatility profile heading into the following decade or two as compared to startup enterprise. That's just clear as day. I don't think you're going to get these 99.5% collapses in Ethereum price, especially not Bitcoin. And that means the cash flow is sustainable, which is quite interesting. And this is what I mean with these yields becoming systemic. And it's not just real world assets where you got treasuries on chain or bills on chain, and that yield pushing through the system. You also have the Ethereum yield, which Raul talks about, pushing through the system, and it creates all this financial activity and reduced volatility profiles and all these very new, interesting points of confluence indicating which assets have more significance than others with regard to being real enterprise and the potential to offer real cash flow. So FXN certainly is something I've been looking at. And thus far, I've defined it as it's moved. I don't see an opportunity here. I want the retrace, and I probably won't get one. And the last thing I want to do is chase. I won't chase. I don't need to chase. And that's important. It's important to be able to say no. And there's plenty of folks that will say yes, and that's okay. And you will have to live with the way it plays out. But there's one thing for certain. If you get the discount, if you bought it at $14, if you wait for 80, a dip below this SMMA, whatever the hell it is, I wish I had my indicators. If you wait for that correction, then when you buy at a discount, you have much more wiggle room, much more comfort. You didn't buy at a freaking top of Mount FXN. What an incredible chart. That's lovely. So FXN, cow, maybe I'm looking at this thing, but I don't know. What's the potential on Arbitrum? What's the potential flows? Why would something go to Arbitrum versus Optimism versus whatever, versus AVAX, Solana, Phantom when it gets reborn in the next cycle? What's the potential flows? What does it offer as compared to another network that does the same thing? This literally is an exchange that's integrated with Paraswap. It does the same thing as CowSwap and everything that occurs on mainnet. It does the same thing. One asset for another. It's not something I need exposure to. Why? Because we already have Curve. And it's on mainnet, which has much more liquidity than any of these networks. Redundant exposure to businesses that do the exact same thing. Hope that helps. I often buy high and sell low. Yes. Well, don't buy high and sell low. That means you have to say no. You buy things when they're a discounted price, when you have some sort of systemic instability, when you have a significant retrace. And folks that own Grail at 681, it runs up to 2,000 and then it collapses to 0.618. It collapses to 1,300, and you see some nice selling from the early buyers. And that cures the vested interest. It resets the cost basis to a new higher level. At some point, early buyers are going to get itchy because they're sitting on a 1020x. And you turn 50 grand into 500 grand, someone's going to be selling. And they own a lot more of it down here. And you get your dips. Look at the candle. That's a big candle. This is a daily chart. That's where we are in this cycle. We're looking at microcap daily charts. But you'll get the nice dip because that's the volatility. Be nice to see a dip to 70. So you see a big series of candles or one big candle to 70. There you go. And you're buying it and you're afraid because it's a massive red candle, but you're not buying it expecting it to go up. You're buying it because it's an asset, a enterprise you were looking at that has a discount now available because earlier owners have gotten out, which presents that discounted price opportunity. 5 mil market cap. That's wonderful. Well, what do you think of side chains had? I think I answered that in most regards. I don't have a high opinion of them. I think they're technologically meaningful, but I don't see the systemic significance. I mean, why? What is, crypto? Everyone says this whole adoption thing. And that's adoption of what? Speculating on exchanges? That's not adoption, it's settlement. And the real yield. People investing, gaining access to cash flow that manifests from cash flows that are actually there. And then they're there. It's not really speculative cash flow, it's cash flow. Getting 5% from bills on SDI, it's cash flow. So that's an interesting adoption because that means more people are buying T-bills. So I don't think the general public buys that. The general public lives paycheck to paycheck. 2/3 of the United States lives paycheck to paycheck. So I'm not big on retail adoption as a narrative for these businesses. These businesses this is a financial economy, a pure financial economy. So you're talking about investors and you're talking about high net worth individuals, you're talking about collateral and borrowing and leverage and lending. It's a relatively sophisticated market. And that's big money. So to me, that screams all mainnet. So it doesn't really identify the use case for the L2s. I mean, it just doesn't. What's the L2 for? It's fast. It's cheap. What does that mean? These fees are not big. $500, $1,000 for someone throwing around $100 million means nothing on mainnet. And that's the flows. That's the big flows, or the bigger flows. I mean, real global financials is the billions. So if you're talking about like micropayments and swiping debit cards, I think that's for like a Juno, and then they batch it, not batch shit. They batch it, BATCH. So they batch it. That's at the company level and how they facilitate settlement, the settlement companies. Now you know what would be a narrative. All right, fine. You got me, Dan. I got one for Arbitrum optimism and whatever. Merchants accepting payment, direct crypto settlement. You're not going to be doing that with mainnet because of the transaction fees, but you do that with the side chains easily. There's your L2 your L2 narrative. But where are we with merchants accepting crypto for settlement? No, they want to swipe a stupid credit card. They operate in fiat wonderland. So that rings as a very meaningful narrative to me. That's the L2 narrative. Real world settlement. Fine. Okay. Solana does that pretty good. I don't know. So it's still not, it's still that whole, it's unanswered, but that's interesting. You have to think about the things that potentially will be to understand where things are, thus where they may head. And that's how you get shit early, and that's how you get shit at a discount. Between Sol and FTM, which would you choose? Choose for what? Choose for purchasing? Neither. Um, Sol looks like it's at the 10 SMA in the 3 months, so I don't expect appreciation from here. I expect a discount to be available at some point. But what's the expectation? You buy at 24 and it goes to 240, that's a 10x. Or it goes, what's the market cap? Is Sol going to take over the market cap of Ethereum? I don't really buy that. So if you go on things like that, this qualifies it as a type of money, like the FX part of the portfolio. And if this could give you a 10x, I'd rather go for just the more comforting Ethereum, which has a more established narrative. I mean, this thing is brand new technically. Sol is brand new technically. Literally, it came out mid-market, mid-cycle, 2021. So everything changes. The entire equation changes if you have it dirt cheap. If you have Sol at $8, nothing matters. But at these prices, it already ran almost 10x. It's a different consideration. It's not at a discount. Similar overtones for Cosmos didn't break out yet. Atom is still below the monthly time weighted average price. But this is one of those assets I have much cheaper years ago. Interesting that Cosmos Atom, the center chain, came out in 19. So this is one of those early assets I grabbed back here. So that's just further comforts me that it's just whatever, just let it sit. It's not really cash. It's kind of let's see what happens. It is productive, even with their new inflation protocol change. It's 10%. That's rough on asset prices, 10% inflation. We'll see how this protocol matures. It's network of networks, big narrative. Same thing with Polkadot. Very similar timing. Still remember their 100-to-1 reverse split. This is at a discount. Very different narrative. This is still at a discount. There's below resistance on a monthly. It's barely moved. $3 to $5, less than 100%. So you got to look at the charts and see your discounts. Or it just got absolutely decimated and it doesn't really have too much traction. Needs to hold above the weekly TWAP. Doesn't look too good on the monthly. It's also a relatively new asset. No history to go on in that regard. Really needs some other factors in the mix that indicate some confluence. Stargate has a very big narrative. Has cash flow. Produces about 10% in my experience, which is meaningful, and that's obviously all revenue. Very interesting. Anywho, last couple of questions. We'll wrap it up. Luke, Cap, any thoughts on RDPX? Dopex is interesting. Everything Tetranode does is interesting. All right, so 1%, but even if it's a 1% play, you still got to catch a discount. So you got to hit the technicals and see where it is. Don't buy shit at a premium. It's not worth it because at some point in the future, there will be things on a discount. There's always something at a discount at some time or another, and you can't own everything you want to own. Always remember. By the way, much love for everything you're doing for us. You're very welcome. You know, I do it as much for myself because talking like this helps evolve the narrative and the story and how we engage with these markets in a sustainable way. Will BTC drop below 20K? I don't think so. But does that help? If it drops to 20K and it rips to 250 grand, it's a little over a 10x. Is that the expectation? 10x on $1,000, $10,000. 10x on 10 grand turns to 100 grand. Depends on your expectations. If the entire exercise of turning 10 grand into 100 grand is the goal, one, you're going to need to sell the top. So you need to understand the macro indicators. Two, you have to manage it like an FX portfolio, which means they're not really investments, they're transitory investments. And three, 10x is usually not everyone's expectation. They kind of want more. So Bitcoin's going to underperform compared to most altcoins. It'll underperform compared to Ethereum. It's just what it does. But it's the significance of it is that it's increasingly less volatile as time goes on, which makes for a better cash as compared to the other crypto assets. Obviously, a poorer cash as compared to literally a settlement currency, because you literally have to convert it to a settlement currency at opportune times. Thus, why I define it as FX, or put it in the FX category. So I hope that helps. It depends on expectations. 10x on Bitcoin. I put my Bitcoin into Ethereum at this point. It's at a discount. Ethereum's at a discount relative to Bitcoin. It's still below the time-weighted average price. So this is everything. You're either buying at a discount or buying at a premium, and I'd rather buy at a discount and have risk of downside. I have risk of a higher low Bitcoin denominated than buy at a premium. Buy at a discount. And structure the portfolio and respect the portfolio and do all those things we talk about. And investments are not cash, and cash isn't what everyone thinks it is. Cash is Bitcoin, Ethereum, stablecoins. What kind of stablecoin? What are the risk profiles of the stablecoins? And if you have cash in this FX basket, it means you got to manage it. You got to swap back and forth depending on cyclical and macro financial conditions. So that's why we'll keep doing the stream, telling you guys what the cyclical macro financial conditions are. Okay, so 100x. The problem with 10 years, I mean, we literally had 20% consumer price inflation since 2020. On average, everything is up 20+%. And you're going to have your cyclicality with energy. Look at home prices. So that becomes a factor when you're talking about 10-year time frames. Bitcoin is not the investment it used to be. Bitcoin, and it's not the same market. So history rhymes, it doesn't repeat, becomes relevant. Ever relevant. You're not getting these kinds of runs. You're not getting 50,000% runs in Bitcoin. There's no easy way to get these kinds of returns. You know the kind of risk people took back then? They had no idea. 12,500. So there's diminishing returns over time as the price of the asset class stabilizes. And that is a base case for Bitcoin maximalists. And I agree with it. It'll stabilize. And I just define it as in the FX bucket as a cash and a volatile cash, and that's cool. I don't expect there's a better chance at 100x with not Bitcoin like an Ethereum or Solana, but these types of assets, all these assets, 1, 2, 3, 4, 5. I define it as the cash bucket, even Solana. It's just that you don't need exposure to it because I don't need that kind of volatility. But they're not enterprise, so they're not cash flow positive unless you wrap them in a derivative of some kind. So I would use it as a form of cash. And what does that mean? If I need to go to the grocery store and I have $50 worth of Bitcoin, you throw it on a debit card and you go to the damn grocery store. Use it as cash. But if that dollar is going to outperform the Bitcoin, depending on cyclical macroeconomic conditions, you shouldn't have the Bitcoin, you should have the dollar. So you need to manage the FX basket of the portfolio accordingly. But Solana's not at a good point for those kinds of returns. It's already ripped almost 10x, as I said. You don't know. So what is risk reward? I mean, it's right about here for Polkadot. Um, that's barely moved, and it pushed through. It held as resistance, but we don't know what this network is going to become. It doesn't have a large DeFi series of protocols. This is early stage. This is kind of like thinking about what was going through folks' mind with regard to Bitcoin. The narrative was kind of there 2012, but it wasn't. Few people, nobody saw what it is today. It was impossible. So that's the same thing with many assets. Nobody knows what this is going to become. Can it become redundant? Can it be invalidated? Of course. And that's the same that must have gone through everyone's mind with Bitcoin in the earlier cycles, all the way back to 2012. Nobody had an idea, except Hal Finney. That guy had an idea. Hope that helps. Hope that helps. So let's wrap it up for today. I appreciate all of you sticking to the end. 30 people made it to the end of the stream. Monday, November 27th at 12:51 p.m. Thank you all for joining me. Tell everyone to subscribe. In the description is a link to the most rational community in the entire crypto space. I appreciate everyone surviving the bear market in there. And cheers to things going in a good direction. I'll see you guys later this week. Peace.